Good afternoon, ladies and gentlemen. My name is Gabor Kiss, and today I would like to talk about the COVID-19's effect on the European Union and to summarize that what can we know about its economic effects in November of 2020. So, today's presentation will be structured as the following. So, first I would like to talk about the macroeconomic impacts. So let's check the output, let's see the inflation, that's why the monetary policy will be analyzed as well, and also we will check the foreign exchange rates. And after that we will switch or turn towards the fiscal policy, so how sovereign debt funding is done today, what are the conditions on both government bond markets, and how the European Commission and the European Stability Mechanism would like to balance all these things out through the assets of the fiscal policy. So, first of all, if we are looking on the COVID-19 recession, we have to say that actually this is the first time when recession is not related to finance. Because this is practically a technical recession. We can say it because mostly it was the result of lockdowns. So if you are closing down all the operations in the economy, obviously it will be in the state of recession, unfortunately. However, if we are looking on the business cycle clock of the European Commission, which is available online, if you are using this link here, then we can say that before the COVID recession, the Eurozone was already in the state of slow growth. So if we are looking on December of 2019, we can say that Germany, Finland, and some other countries were already in the state of slowdown, economic slowdown. And yeah, we can say that also some part of the Eurozone was still in the state of recovery, so expansion was present. And now we can see that in 2020 October, so mostly after March, economic growth was non-existent, so recession became present everywhere. However, if you are looking on industrial production, because industrial production statistics are always presented on monthly basis, so we can have Q3 data already. And we can see that once lockdowns were over, then economic or industrial production jumped back. So there was a fast recovery. However, if you are calculating or computing output gaps, which with HP filters, we can see that recession is not over. So we will see Q4 data and next year's Q1 data will show us that this was a temporary recession, or we are in a double V-shaped recession. When we are falling down, there is a recovery, then we are falling back again. So yeah, but until we are in a state of partial or complete lockdown in different member states, then obviously recession will be present. Yeah. What kind of impacts does it have on inflation? So obviously, if you are not able to purchase anything because you are not able to go to restaurants, you are not able to go to parties, you are not able to go on holidays, then it means that you are not able to provide any kind of demand for specific products and services. So it means that deflation or pressure can be imminent. Also, if people became unemployed because of these lockdowns, then obviously it generates or pushes also the market towards deflation. So we can see that unfortunately now we can have deflationary wave, a third deflationary wave after 2008, middle 2010, and now we are also falling down. So this is a deviation from targeted inflation in the Eurozone. But also we can say that the weak demand was present already before the Covid-19. Just Covid-19 was reinforcing this kind of impacts. So that's why we can find some voices nowadays, even at the European Central Bank, which are saying that maybe central banks should increase the tolerance band towards inflation, because if you can fall easily in the negative levels, so it means that for the Eurozone, if you are under minus 2% of the inflation band, that it means that technically you are at zero inflation. And it's not that healthy to conduct a monetary policy in this state. Also, we can say that, yeah, but what is happening outside the Eurozone? So if we are checking Central Eastern European countries, they were subject of currency depreciations, and as a result, they had this foreign exchange shock. It was a one-time foreign exchange shock. So if you are checking the inflation reports in Czechia or elsewhere, then we can see that central banks are considering it as a one-time shock. Okay, it affects the import prices for once, but it's irrelevant from medium run or long run inflation perspectives. So if nothing good happens in the Eurozone, then sooner or later they will continue or follow them to deflationary state, which can be dangerous. So we can see that this happened also before in the mid 2010s, when actually, yeah, we had inflation, and then actually they followed the Eurozone in low inflation state. So that's why they have to be really careful what inflation says. If we're looking at monetary policy, then we can see that actually ECB became even more accommodative than before. So next to their traditional security purchase programs, when they are purchasing bonds on the primary markets from banks, from corporates, or from companies, and actually, if we are looking on the balance sheet, then we can see that lending became more significant. So compared to the lending programs in 2008 or 2012, we can see that they were even more aggressive than before. And also, if you are looking on security purchases in 2008 or in 2012, we can see that it's increasing even more. So they kept interest rates at historical low levels. Yeah, this is the trap here. Because if you have really low inflation target, it means that you can't go under some levels with the interest rate. So you can cut it back easily, but they cut back it already in 2009. So since then, interest rate is not an instrument anymore, because it's already close to zero or sometimes negative. And also they initiated this long-term refinancing operations, so they are providing loans to the banking system, where the maturity is around 1.5 years. Also, they added additional long-term refinancing operations, also with a maturity of nearly a year. Also, they started to play with the capital of the commercial banks, what I don't like so much. Okay, liquidity coverage ratio, if we are lightening this a bit, it's not a big deal, because as a central bank you can manage liquidity conditions in the banking system. What I'm afraid of is that they are starting to play with the capital conservation buffer, which should be crucial in a state of a bank crisis. Okay, counter-cyclical capital buffer, you can play with that because that's why it's created, but I don't like that one. If you are checking the website of the European Central Bank, there is an excellent working paper which describes why it's a good thing to deal with capital adequacy. Just this is my own personal opinion that I'm afraid of this. And of course, currency swap lines among the key central banks have been initiated even more, so it's a popular territory since 2007 December. Sometimes it's decreasing, sometimes it's increasing. Right now it's increasing a lot to provide foreign exchange liquidity. Mostly euro or US dollar liquidity is distributed amongst the key central banks and also in the neighborhood of the eurozone. So other central banks which are not using euros, they can get also euro liquidity from the ECB. In this case, you can bypass markets. So it's a nice thing. If I'm looking non-eurozone central banks, so let's see this sample of the Czech National Bank and the Swedish Riksbank. We can see that Czech National Bank was highly conservative before the crisis of 2008 and since then, because they had a really excellent supervision even before the 2008 crisis, so they were not that hard, and we can see that that's why, because they were able to avoid the build-up of huge macroprudential risk in their banking system. Since then, they can say that okay, they have to use the tool of interest rate policy not that much. So, okay, they made nicer accommodative monetary policies, but no negative interest rates at all. And also, they were able to say that okay, we can allow some postponement in the loan installments at the banking system. Also, they were balancing the loan to value ratios at the mortgage at the banking system, but it's smooth and nice. So it's I'm a great admirer of the Czech National Bank, and they're serving to that. In the case of Swedish Riksbank, this is what we can see in many cases. So many central banks are creating enormous programs. So they are saying that we have huge capacities for lending. So in their case, it's 500 million Swedish kronas. On the other hand, the utilization can be really narrow. So we can say that, okay, they are providing loans, they have a lending program. But on the other hand, we can say that from 500 billion SEK, they will use only 165 billion SEK. Small money. Also, we can say that they initiated a huge security purchase program to purchase government bonds, covered bonds, municipal bonds, corporate securities. At the end of the day, they used a quarter of this money, a bit more. Also, if you are looking on that, they initiated a huge US dollar lending program, and after that only 2 billion was used from that. So in many cases we can see that okay, as a central bank you have to calm down market. So if you are initiating an enormous lending program or security purchase program and so on, then you have to say that partially you are providing liquidity. On the other hand, you want to calm them down that okay, if you need liquidity you can get it. But if it's available on market basis, then you are just reinforcing the market. So this is what we can see here. So even they were saying that now they are dealing with previously known counterparties, but it means that they were selecting 5 Sparbanken, which means regional small banks, which is not bank, but it's like Sparkasse in Germany or Takarékszövetkezet in Hungary. So it's small players which were not supposed to be their counterparties, but actually because they are completely marginal. And now they are dealing with them. So it's a nice gesture, but it's not a huge step anyway. You can do it because whatever. Yeah. And we have to talk about foreign exchange rates. And in the case of foreign exchange rates, yes, we can say that, okay, in the emerging Europe, so for example, Hungarian forint was a subject of huge depreciation against the euro. But if you are using SDR, which is the basket currency of the IMF, combining US dollar, euro, Chinese renminbi, and Japanese yen, then we can see that actually nothing dramatic happened here. So Hungarian forint is still stable, Polish zloty is still stable, so we can see the same dramatic depreciation like what happened against the euro. And also if we are checking the correlation amongst different currencies, regional currencies against or with euro, then the correlation is really strong. So we can see that, okay, that was the setback of the depreciation period. But after that, the correlation is bigger than 0.8. So they are working hand in hand mostly with the euro, except when they are depreciating. So that's why we can say that it was highly reasonable not to use monetary policy to lean against the depreciation, because we can say that it's a structural issue. If in SDR we can say that there is a depreciation now on the market, then you should do it. But right now it's not that significant. Okay, let's continue with the sovereign debt. So if we are looking on the yields, long-term yields, or even at the steepness of the yield curve, then we can say that nothing to see here. So it's not like a sovereign crisis thingy what happened in the 2010s that suddenly yields started to increase. So you can finance yourself it on market basis really easily, and actually the cheap basis. So even in Hungary, we can see that long-term yields are around 2%. Even compared to 2008 or 2018 or 2017, still we can say it's cheaper. If you are looking on Polish or Czech cases, or especially euro area, then we can say that it's mostly managed or pressurized by central bank purchases, but we can say that it's viable. Also, the steepness of the yield curve is positive, but it's actually the term spread is really narrow. If you are looking on the difference between the 1 year yields and the 10-year yields and the yield curve, so actually funding conditions for sovereign entities, they are not, they are still accommodative, so we can't say that there is any kind of shock here. And if you are looking on the European Union's response on this issue, then we can say that they initiated different programs. Right now, I have no idea that what is the success ratio of this case. So we can evaluate what happened here, how efficient these programs were in the next year or during the next year. So right now we can say that, okay, they approved huge programs, for example, to deal with short-time work programs in the different member states. So right now 18 countries were applying for funding. Even Hungary got some funding until October of 2020, and they allocated 90 billion euros for this objective. But I don't know what is the success ratio of this thing, neither the European Commission. Also, European Investment Bank initiated an enormous program to provide guarantee fund and also to provide loans for SMEs. My concern again is the success ratio that, okay, they provided huge potential of giving or lending 200 billion euros for SMEs, and at the same time we can see that only 1 billion euros were approved. So 0.5% of the money was allocated until now. European Stability Mechanism was extended its activity as well, but we know it's only for Eurozone member states, and 2% of the GDP was the limit. So until 240 billion euros can be allocated for this opportunities. On the next slide we can see the details. Also we can see that the budget of the European Union was extended, so you can have, or all the member states can have 3.1 billion euros to reinforce healthcare system, reinforce hospitals. Also an additional 6.2 billion euros were used to finance the development and deployment of the vaccines. Also they purchased an enormous amount of vaccines for the citizens of the European Union. Then later we will see that how it was used exactly in the real life, but the money is there right now, so we can say that they were sitting and waiting for something miracle to happen. They allocated some money for that. Also they redirected cohesion funds to deal with these issues, to support SMEs again, to support healthcare systems, and actually they were using structural funds, unallocated money, so they were just redirecting unused funds to have this. And also they started to have some flexibility in the case of the EU rules. First of all, state aid rules became less strict anymore, so you can support private companies easily. And also they are waiting for fiscal support around 4% of the GDP, so they are allowing that. And if we are looking on the ESM, European Stability Mechanism, then we can see that they created this pandemic crisis support. Right now we can see that how much percentage of this money was allocated, but we can see the capabilities. So if you need some money, still we can say that actually you can finance yourself on market basis, but if you would like to avoid market basis funding, or if you want to show that you can fund yourself parallel with market basis funding, saying that actually ESM is also issuing government bonds, so they are issuing bonds on the market, just their credit rating is AAA, which is not the same for other or some governments, for all the governments in the Eurozone at least. So you can get funding with a maturity of 10 years, and you can use this kind of funding for a year or maybe 2 years, it depends on the situation. And obviously ESM is not running any kind of lending or interest rate risk, so if they can issue government bonds, they can give you the same interest rate of this bond and adding a spread of 0.1% plus their service fee. So this is what we can see for the European Union and the Eurozone as the response towards the Covid-19 crisis. This is what we can see from macroeconomic point of view. This is what we can see as a policy response point of view from monetary and from fiscal fields. So at least in November of 2020. So take care, goodbye, and I hope you enjoy this semester. Bye bye.